One. So just like I said, the next two classes will be done. We now do a kind of revision. Then I'll send your marks, and that will be the end of the class. Okay. So in my last class with you, we already got to allowable expenses, and we have discussed all the allowable expenses. The one that we're going to be discussing today is we continue from where we stopped last class, and we'll be discussing non-allowable expenses. For the non-allowable expenses, there are some expenses that are not going to be allowed. And for example, gas flare will not be an allowable reduction. Gas flare. You remember in our allowable reduction, we said the costs of injecting gas will be an allowable reduction. You remember? We said this is going to be an allowable reduction. Why are we trying to ensure that this is an allowable reduction? Because we don't want people to flare. But a lot of companies today, because they don't have gas infrastructure, they flare their gases. And that is detrimental to the society, detrimental to the environment. Recently, we've been talking about sustainability. Environment is also key as a measure for the sustainability objectives or goal. So, in trying to ensure that people do not just mess up the environment, the government puts heavy fine on companies that are flaring their gases. Okay, so when you flare gas, you are going to be charged more. Therefore, gas flare will not be treated as a liable reduction. The next one is expenses that are not for the purpose of petroleum operation. Expenses not for the purpose of petroleum operations are not allowed. The next one, head office costs is not allowed, which include shared costs, research and development costs, and any other indirect costs will not be allowed. The next one that we already know that depreciation is not an allowable reduction. The next one is expenditure incurred to purchase information relating to petroleum deposits will not be allowed. So when you incur an expenditure that relates to petroleum deposits, as in to purchase information related to petroleum deposits, is not going to be allowed. Remember, in our last class, we said any cost incurred in G&G is a liable reduction. Let's go back to that place. We said any costs incurred by the company in the acquisition of geological, geographical, and geochemical. This is allowed. I'll say it again. Costs incurred to purchase information relating to petroleum deposits is not allowed. However, if you acquire any cost, if you incur any cost rather, with regards to geological, geographical, and geochemical information or data, such is an allowable deduction. Okay, so we have said that in our last class. Keep it in mind. The next one is capital employed in making improvements as distinct from repairs. So cost of improvement to an asset is not allowed. That's what we're trying to say there. The next one, some recoverable under insurance or contract of indemnity is not allowed. The next one that is very fascinating is interest on borrowing. When you borrow money from bank, any interest on it, finance charge, and bank charges are not allowed. Also, litigation costs, arbitration costs, and bad debt are not allowed. Do you understand me? Interest on borrowing, not allowed. Bad debt, not allowed. Financial or bank charges, not allowed. Legal costs, not allowed. That's what we're trying to say here. Any question? Any question? The next one. Tax inputted, not allowed. You know, some companies, what they usually do is that they usually gross up their taxes because, especially when they are dealing with multinational companies that are outside the country, that will tell you that we don't pay tax to foreign country. This is my amount I want to sell to you. So you cannot deduct withholding tax, cannot deduct tax, you cannot deduct anything. You get. So in order to comply with law, companies that they are dealing with in Nigeria will now gross it up as part of the contract. So we are saying that the gross up portion is not allowed. We are going to disallow it because ordinarily those guys are supposed to pay tax. Why are you paying it on their behalf? Okay. So that will not be a live reduction. The next one, tertiary education tax is not allowable. Under petroleum company income tax, tertiary education tax is an allowable reduction. But for hydrocarbon tax or under PIA, tertiary education tax is not allowed. Apart from this, any other form of tax liability are not allowed. We move on to the next one, which is rents or repairs, not for the purpose of petroleum operation. The next one, capital expenditure, custom duties, not allowed. Next, tangible and intangible costs, capitalized, not allowed. And so on and so forth. So all these are not allowed. Okay, so that is it. We now move on to accessible profits. I was teaching the physical students last week, and they were confused as to the definition of accessible profits. According to Companies Income Tax Act, there is no difference between accessible profits and adjusted profits. Therefore, I can say it is the same meaning. However, under PPT and hydrocarbon tax, accessible profit is equal to adjusted profits less loss relief. Okay, so that is it. Do you understand? Any question? Okay. In the absence of none, we'll move on to the next one. The next one is treatment of losses. Number one, how do you treat losses? The amount of loss incurred by a company during the previous accounting year for the period will be adjusted against our adjusted profits. So we said to determine the accessible profit, there shall be a deduction from adjusted profit as stated below. One, loss of the previous accounting period that we are not able to completely recover, rather, will be deducted from our adjusted profit. That's number one. Loss of previous accounting or tax year will be deducted from adjusted profit, which is the same thing that you know. Okay, for a new company, the amount of loss incurred during the first accounting year. So this can go for existing company, and this can go for new company. Loss incurred in the accounting year. The next one, where you cannot fully recover your loss, you can carry forward your loss. Losses can be carried forward. Okay? With the next succeeding year until it is fully recovered. Okay? Now, another provision that is very interesting here is that the taxpayer can defer the utilization of the loss incurred. However, this must be the Federal Inland Revenue Service. However, the FIRS must be aware of this move, and the taxpayer must write a letter within 5 months for the FIRS. Write letter must write a letter and the taxpayer. Do you understand? Taxpayer must write a letter to the FIRS if he is willing to determine to defer his tax liability. So this deferral will be deducted in the subsequent year. Except you also make another election that you want to decide. The next one is chargeable profit. What is chargeable profit? Your chargeable profit is your assessable profit less capital allowance. This class is somehow quiet today. What is happening? Oh yeah, greet me, everybody. This class is too quiet. One by one. I want to hear your voice. Abiola, starting from you. Okay, Mr. Wellington, go ahead.
Good morning, sir.
Good morning.
We are following you. We are following you.
Oh, okay. Oh yeah, the next person. I want to hear your voice.
Good morning, sir. I was in the kitchen. Well, with you.
Oh, you are following. Siri. Okay. Next person.
Good morning.
Good morning, sir.
Good morning, Alaji.
Yeah, we're listening, sir.
Okay. KG, I'm with you. KG, go ahead. KG.
Can you hear me? Good morning.
Okay. Now I can hear your voice. Good. Thank you. Oh yeah. Busola. Busayo.
Good morning, sir.
Good morning. How are you?
I'm fine, thank you, sir.
Good. Was Chidema.
Good morning, sir. I'm following.
Okay. D.
Good morning, sir. All together.
Good morning. D. I'm with you now. D.
Good morning, sir. I just joined the class too. Good morning.
How are you? How have you been?
Fine, thank you, sir. And you?
I'm okay. Esson. Esson, you don't want to greet Tisha? No problem. Amon.
Good morning, sir. We are with you spiritually.
Okay. Kelvin. Someone is missing in this class. Otobo is missing. Kelvin. Okay, I leave Kelvin. Tega. Tega.
Morning, sir.
Okay. Thank you. Good morning. Ufama. And followed by Priscilla. I'm waiting.
Good morning, sir.
Good morning. Okay. Last person. Priscilla. Okay. Since Priscilla did not want to meet us, we'll move on. So, as I was saying, I said to ascertain our chargeable profit. Chargeable profit shall be the accessible profits less capital allowance. Okay. Now, it is very important that we treat capital allowance. Apart from that, we would also less what we call production allowance. So we're going to be looking at this as we move ahead in this class. Okay, let's take capital allowance first. I'm very sure you guys are familiar with capital.
Please, sorry for cutting. There's also somewhere that says for charging profit also, we are to less annual allowances in respect of minimum rights acquisition cost.
Yeah, no. Capital allowance cover that.
Okay.
So let's go straight to the treatment of capital allowance. As you all know, capital allowance is the allowance granted to the taxpayer that has incurred qualifying capital expenditure and put them into production use at the end of the business period. Now, I will say this, it is very important to know that under company's income tax, capital allowance is divided into initial allowance and annual allowance. However, in hydrocarbon tax, we only have annual allowance. There is nothing like initial allowance. That's number one. Number two, all allowances or all assets has or have the same useful life. The same useful life. And the useful life is 5 years. Under your company income tax, they do not have the same useful life. If you acquire a building in company income tax, the building will have 10 years. If you acquire furniture, the useful life of the furniture is 5 years. If you acquire plants and machinery, the useful life is 4 years. Okay, so you can see that we have a varying useful life. We have a very useful life when it comes to capital allowance for companies. Meanwhile, here, our capital allowance can only be granted for a maximum period of 5 years. Having said that, in the last year of use, you remember when we were doing companies income tax, I told you you must retain how much? You must retain how much?
10 naira.
10 naira. Abi? Now, in this place, your retention shall be 1% of the QC. You can see the differences. Shall be what? 1% of the QC.
As in the last year of use.
Yes. So that means you cannot write it off completely. It has to be 1% of QC. Okay? So that is that. So it is possible that we would have a class during the holiday. Okay? It is possible we would have a class during the holiday.
Right, sir.
So we would arrange that and get back to you on the timetable.
Right.
Okay. So now in the hydrocarbon tax, we have classes of assets. Okay. The first class of assets is plants, machinery, and features. The second class is pipeline and storage tank. The next one is building and structures. The next one is drilling expenditure. The drilling could be tangible or intangible. And the last one is the acquisition of rights. These are the 5 categories of assets. Now, this acquisition of mining rights would also be amortized and capitalized. Leave it alone. Will be amortized and capitalized, and at the same time, when you're amortizing it, you are using the same method of your annual allowance computation for that. So those are the categorization of the assets. Now, as I was saying the other time, you remember I told you that our assets will use 5 years, Abi, and I already told you again that qualifying capital expenditure will use maximum period of 5 years. And in the 5th year of use, you are going to retain 1%. You are going to retain 1%. And that 1% will represent the value that you're going to compare when you want to dispose your assets. Unlike your company's income tax, when you want to dispose assets. In this regard, you cannot dispose assets without the authorization of the minister. Okay? Or of the commission, NUPRC. You cannot. You have to always ensure that you deduct the assets, you carry them along when you want to dispose the assets. Okay? That is that. And that 1% represents the tax original value upon which you are going to be using to compare with your sales process. Okay? So that is that. also note that for drilling, okay, or exploration expenditure, the first exploration well shall be expensed. The first two appraisal well, I hope you are jotting all this thing down. Appraisal well shall be expensed. What now happened to other wells after first exploration well? Anything after first exploration well shall be capitalized. Anything after first to appraisal well shall be capitalized. That is, third and subsequent one for appraisal well. Now, if you are now capitalizing that, what does that mean? It means you need to calculate capital allowance on the assets. Do you understand? That means you need to calculate capital allowance on the portion that you capitalized. Okay? So that is that. Let's move to the next one. If that is the case, we can now move to some illustration so that you would understand what I am saying. In your study pack that you have there with you, we said the following information was extracted from the accounts of Ramon Oil Limited for the year ended 31st December 2023. What is our accounting year end? Our accounting year end is 31st December 2023. Note that. I take you back to my last class with you. What is accounting period? The accounting period of upstream companies shall be from 1st of January of that year to 31st 12 of that year. Meaning that the company is on actual year basis. Actual year basis. What is an actual year basis? An actual year basis is a base period that must have started and ended within the tax year. Therefore, if my tax year for this company is 2023, my basis period shall run from January 2023 to 31st 12 2023. That is the accounting period of this company. So, having noted that, the question the examiner gave us, he said, year of acquisition. $2019. QC, plant and machinery, value, 18. Now, listen and listen attentively. An asset that I acquired in 2019. And don't forget, this data that was given relate to 2023 year of assessment, right? Now, how many years has this asset used? The asset has used 2019, 20, 21, 22. And in 2023, that means the assets will clock 5 years. Abby? So this is year 1 that we bought the assets, year 2, year 3, year 4, and year 5. According to what I told you, I said in the last year of use, the annual allowance rate shall be 19%. In this year, 2019, 20%, 2020, 20%, 2021, 20%, 2022, 20%, 2023, which is the last year of use, will now be 19%. So this is a 5th year of use of this same asset that was acquired in 2019. And the fact that it was acquired in 2019, we must calculate annual allowance on the assets and use 19%. Do you understand?
Yes.
Any question? Good. No question. Okay. If there is no question, we can move ahead to the next one. So that means if I'm going to calculate my annual allowance on the asset I acquired in 2019 in 2023, that means I'm going to use what percentage? 19%. Okay? So that is that. So let's now calculate the annual allowance for all these assets. Year of acquisition, you see value, annual allowance rate, annual allowance. What is the rate? 19%. So in 2023, I'll be using 19%. In 2020, the asset I acquired, tangible drilling cost, I acquired for 17.6. As of 2023, how many years has that asset used? It has only used 4 years. Abi? So it will still give you 20%. The one that we acquired 2022, pipeline, 19 million, 20%. 2023. 2023. Building. 15,400. 20%. 20%. So you now calculate it, you get your answer. That will be your total annual allowance for the year 2023. So if you open your study material, you will see it that we have done it that way. Any question?
Yes, sir. Sorry. Based on your former explanation, I thought maybe this 19% it will be on the 5th year, that's last year.
Yes.
Okay. I was expecting maybe this 19% will be on 2023.
Yes. So this our table, open your study material. The table is for 2023. Do you get?
Okay, yes.
In year 2023, what will be your annual allowance for the asset that you have acquired in 2019? Do you understand?
Yes, sir. Yes, sir.
Yes, sir.
Right.
Yeah, I still don't understand this computation. So the rates that we use now, how did we arrive at the rates? Are those rates given in the questions, or we arrive at those rates calculating some things? I'm kind of lost now.
Who is that?
Among me.
Okay. So the rates will not be given to you in the exam. You are expected to know these rates. And that is why I am taking my time to explain it. You are expected to know the rates. Do you understand? So, you understand how we got 19%? Among.
No, sir.
Among, are you in this class today?
I am.
You are not here.
I am. I just got lost along the line, sir.
Okay. Let me find you. You remember, I told you that all qualifying capital expenditure has 5 years.
Yes.
Abi?
Yes.
And for each of the year is 20%. Okay, if I say an asset has 5 years to use, to calculate my N, you remember, I usually tell you 100% divided by annual allowance rates in percentage. Abi? Now, we know that it's 20% for annual allowance. So, or let's assume that we just know that the asset will use 5 years. So we have 5 is equal to 100% divided by annual allowance rates. Okay? So how do we get our annual allowance rate? Cross multiply. So you would have 5 AR is equal to 100. I need my rates. AR will now be divide both side by what is the stop AR? That will be 100 over 5. AR will now be 20%. So my AR, that is annual allowance rate, is 20%. Because we said all assets will use 5 years. So that is that. Now, but I said you must retain 1% in the last year of use. I said under company income tax, we usually retain 10 naira. Here, you will retain how much? 1%.
Let me come back.
So that means in the last year of use, you must retain, in the last year of use, you must retain 1%. So that means Soji, mute your mic. That means in the 5th year, I must now have 19% because I am going to retain 1% in the 5th year of use. I don't want to. So do you still have any question? So in this question now, we now said an asset that we acquired in 2019. That was why I did this table. If I acquire an asset in 2019, that asset will get 20% annual allowance. In 2020, that asset will get 20%, which is the second year. In 2021, 3rd year, 20%. 2022, 4 years. 4 years. That will be 20%. But in 2023, which is the current year that we are interested, the assets will be calculated. We are going to calculate 19% because that is the last year of use of the asset. So in 2023, I am introducing 19% for the asset I acquired in 2019. Do you have any questions? Any question? Okay.
Okay, I get it now, sir. So other years are still 20% because they are less than 5 years, right?
Correct.
Okay,
Correct.
thank you.
Good. So let's look at the next illustration. ABC Limited made first sales of chargeable in 2018 under the program of continuous production and sales. As at 1st January 2023, the company acquired plants expenditure for 50 million. When was it acquired? 2023. The company acquired an expenditure of 50 million. Between 1st of February 2023 and 31st December 2023, additional qualifying expenditure was incurred, and the amount is 60 million. That means the total asset this company acquired in 2023 is 110 million. This examiner now says, determine the qualifying capital expenditure, which is this. Determine the residue of the qualifying capital expenditure of the company after 2027 year of assessment. Don't forget, this is 2023. So let's go. In 2023, that we acquired the assets, costs. We acquired it for 110. We have annual allowance. 20% of this will be 22 million. In 2024, actually now value will be 88 million. In 2024 too, we calculate annual allowance. Our annual allowance is constant. 2025, actually now value 66 million. Annual allowance in 2025, 22 million. $2026, actually now value 44 million. Annual allowance 22 million. In 2027, actually now value, that is 22 million. You remember, 2027 is the last year of use. Because it's the last year of use, I'm going to retain 10%. So if I calculate 10%, sorry, 1% of the cost. 1% of the cost gives me 1.1 million. So I'll remove 1.1 million from this guy, and I will have 20,900,000. my tagging now value after 2027, which is the residue the examiner is asking for, will now be 1. Do you have any question?
Yes, sir. I have a question here, sir.
Right.
For the 2023 year of assessment, some of the qualifying capital expenditure were acquired way into the year. Are we not supposed to prorate for the annual allowance for those qualifying capital expenditure that were acquired way into the year? Like the one that was acquired. You know what?
No, sir.
Thank you, sir.
You know why?
No, sir.
Okay, I'll tell you. The reason why we are not going to prorate is that you remember that when we have our basis period, we said when we have our basis period for asset allocation, in 2023, my basis period would have been 1/1/2023 to 2023. Remember when we were doing our capital allowance, we said any asset acquired and the base period of the asset, or the base period of the year we acquired is not less than 12 months. It gets full annual allowance. So the base period in the year we acquired it is not less than 12 months. Then we will get full annual allowance. Do you understand me, please?
Yes, thank you.
Okay. Any other question? Another question. Okay, we'll move on to the next one. So we'll move on to the next one. The next one is balancing charge and balancing allowance. You know what our balancing charge means? Balancing charge is when your sales proceed is greater than your terminal value at disposal. Balancing allowance is when your sales proceed is less than terminal value at disposal. So that is that. So let's go straight to production allowance. Production allowance. The examiner has actually not tested this section of the act the way I am expecting it to be tested. The examiner had only been giving the production allowance as a whole number without asking you to calculate. So we don't know, maybe that is what they will continue to do. But in case the examiner decides to change their ways, the examiner could give you some scenarios. Then you need to calculate the production allowance. Let's go. In calculating production allowance here, how do we go about it? I know you have your study material in front of you. For conversion contracts, for conversion contract, your production allowance shall be lower of $2.5 per barrel and 20% of fiscal price. I'll say it again. So for conversion contract, there are some contracts that have been existing before PIA came in. So for the conversion contracts, we said that company would have to calculate its own production allowance on the basis of lower of $2.5 $2.05 50 cents rather per barrel and 20% of fiscal price. So imagine that we have 10,000 barrels. Production allowance that you will get on that would be this will be 25,000, right? $25,000. Assuming the fiscal price of this product is $80 per barrel. So that will be barrels multiplied by $80 per barrel multiplied by 20%. What would you have? What do you have? That will be 80,000. Is this one correct? This one. Respond though, so that we can move fast.
Yes, sir.
Okay, give me the value for this one.
What are you doing? Don't waste my carrot. I'm warning you now. $160,000. Is that 10,000?
Yes.
$460.
So the answer is you take the lower of the two as allowance, which is 25,000. Do you understand what I'm saying? This is in the case of conversion contracts. Do you understand me? Any question? You are not talking, no. Does that mean we understand it? Okay, classwork. Classwork. Assume the production is 50,000 barrels and the fiscal price is $35 per barrel. So calculate the production allowance. Oh yeah, I'm waiting. 2 minutes.
Hello, sir.
I'm with you.
As $125,000 and $350,000.
Which one is 125?
The answer is 125,000, which is the lower of the two.
125,000 is what? 20% of the physical price?
No, 2.5 times 50,000 barrels.
So the lower is $125,000.
The second one is what? How much did you get?
$350,000.
Which one would you take? Lower of the two?
2.5 times. Yes, sir.
So we now understand that one. We can move on to the next one. So the next one is for onshore area. For onshore. Onshore means on the surface, not shallow water. Do you understand me? Onshore area. What does the ask say? The ask says the production allowance shall be lower of $8 per barrel and 20% of fiscal price. This is subject to a cumulative maximum of 50 million barrels. Now, where it is more than 50 million barrels, the excess shall be calculated as follows. Lower of $4 per barrel and 20% of fiscal price. Okay? So that is that. Let's do it. Let's do an illustration. Assume the production is 30 million barrels. So calculate the production allowance. That will be lower of $8 per barrel multiplied by 30 million barrels. So let us also assume the fiscal price is $50 per barrel. So that will be $50 per barrel multiplied by 20% of fiscal price multiplied by 30 million barrels. What do you have? The first one is 24 million. The second one is 20% of 50 times 10, 30 million.
$8 per barrel. That should be 240 million.
This should be 300 million. Are we?
Yes, it is.
So we are taking.
Yes, sir.
It's 300 million. Are we? So we are taking the lower of the two, which is 240 million as your production allowance. Okay? But let us now assume that the production is 60 million barrels. To calculate my production allowance, I'm going to have $8 per barrel multiplied by 50 million barrels. This will be $50 per barrel multiplied by 20% multiplied by 50 million. What do you have? Please answer me. This will be 400 million. The second one will be 500 million. We say we'll take lower of the two. Meanwhile, you remember that we said any excess of 50 million, which is 10 million. So the 10 million, so we've known this should be 400 million. Abi? The excess now, which is 10 million. What do you do to the excess of 10 million barrels? The excess of 10 million barrels shall be calculated at $4 per barrel. It's possible. Okay, so this will be how much? $4 million or 40 million. We now say fiscal price, which is times 20% times 10 million barrel. So what's the multiplication? What do we have? That will be 10 million or 100 million. What do you have? 100 million.
100 million.
The lower of the two, 40 million. Total allowance, 440 million. Do you understand? Any question? Any question? Any question? Any question?
From
You
me.
didn't get the last part. Which one did you guess?
The calculation of the 10 million, sir. The last calculation you did, sir.
The threshold for the first one is 50 million. Anything above 50 million will go to the next threshold. So for onshore production, for you to get production allowance, your first 50 million will be at $8 or fiscal price, that's 20% of the production. Now, if it is now more than that, if it's more than 50 million barrels, we go to the next line, which is $4 per barrel multiplied by the excess. And excess of the 50 million, 60 million is 10 million. Do you understand me now?
Yes, yes.
That's the excess. Any other question? Busoyo, do you now understand this now? Class work.
Yes, sir.
Good. Class work. The same parameter, but let's assume it is 80 million barrels. 80 million barrels. $80 million barrels. So assume the fiscal price is $40 per barrel. And yes, assume the fiscal price is $40 per barrel. So this is what you are going to be given on the examination commission. They'll give you the fiscal price and they will tell you the area of operation. The area of operation is onshore. It is now left for you to know how to calculate. So go ahead and give my value. Yes.
I don't know. The first calculation I did, the two is 640 million. So I don't know how to pick the base.
Wait
Exactly.
now. The first one,
640.
640. What about the second one?
It's also 640. I don't know. Maybe I'm not getting it right. So.
Okay, someone else.
The first one is 400. The same amount for the two, for 400. And the second one is 120. The other one is 240.
So the first 400, the first 50 million times $8 per barrel. 400 million. The second one will be $40 per barrel, Abi, times 20% times 50 million. What do you have?
400.
There's no lower here, so you take 400 million, Abi.
So I use
so excess.
Total allowance is 520.
Excess.
Wait. Umi, what are you saying?
I said I use
80.
Yes, instead of
you are not following me then. So the excess is 30 million. Abi?
Yes, sir. Yes, sir.
So the 30 million will be at $4. Abi?
Yes, sir.
That will be 120.
120.
Mm-hmm.
Abi?
Yes, sir.
Correct.
The next one will be
40 times 20%.
40 times 20% times 30. What do you have?
240.
40. The lower of the two, 120.
120.
Addition, 520. Can you see
20.
your error? Do you understand this now, guys?
Mixed
Yes, sir.
function conversion contracts.
For conversion contract, it's straightforward.
Yes, I see that the mixed
Yeah. The next one for shallow water, the same way, but the production has now increased. If you are producing 100 million, so it should now be first one, maximum is 100 million. If you produce over that, you have to do the same thing we did in the first one. So this would now be $8 multiplied by 100 million. That would be 800 million. Lower of 20%. Let's assume the price tree is $50 times 100 million. That would be worth 1 billion. Lower of the two, 800 million. Now let's assume you now produce more than 100 million barrels. Let's say 140 million. So you first do your first 100 million, which is what you got here the other time. Excess, which is 40 million times $4. That is 160. Abi? 40 million again, multiply by 20%, multiply by $50. What do you have? What do you have? %20 of this, that will be 400 million.
400.
Lower of the two is 160.
160.
If I add this, I will have 960. So that is the production allowance. Any question? Okay. In the absence of no question, we will go to the next one, which we will discuss within. What's your next class? What time is your next class?
10.
Is your lecture always prompt? Is it always prompt? I want to know if we can go to the next one or we leave it to the next class. Okay, my next class with you, we shall be discussing cost price ratio. This is what we'll be discussing in our next class. And our next class will be most likely to be on Monday morning or Tuesday. Please don't miss the class. Okay? So, good day to you.
Hello, sir.
Yes.
Okay, I don't want to, because of that money. What if, so that we can leave that time of Eid? We are not sure whether it will be Monday that will be Eid.
Or
the
Tuesday.
prayer is done by 10 a.m.
Is it Monday or Tuesday?
It cannot be Tuesday. It can either be Sunday or Monday.
Okay, so let's do Tuesday.
Yes, sir.
Tuesday morning.
Okay, sir.
All right, I'll get back to you on the timetable. So for that Tuesday, the class might be more than 2 hours. Let's do like maybe 3 hours class. Okay?
Okay, sir.
Good day to you.